Hello Rockstars, I hope you're all doing amazing. Welcome to this super fast revision of the chapter Standard Costing. Yes, you guys won't believe it's 9th November. Time here is 3:48 a.m. I have not slept the whole night because tomorrow is your examination. So I have been working with so many videos. Yes, so many things. Yes, I always tell when it's exam for you, it's not just exam for you. Along with that, it's also exam for me. So the two and a half days, I'll also be sleepless. I'll also be always anxious, telling how the examination is going to be. Yes, let's try to give maximum to our students. Yes, so now just telling, just because I'm all alone here, just thought of sharing few thoughts running on my mind. Now coming to the chapter, my dear students, standard costing, considered a nightmare by many, but believe me, it's one of the simplest of the chapters. Now a very important caveat here, my dear students. Yes, we'll try to explain and revise standard costing in the littlest time possible. Yes, the target is to finish the chapter within 45 minutes. Now, believe me, conceptual explanation, derivation of each and every formula, telling what the formula is, why the formula has come, how the formula has come, all of that is not going to be possible in the limited time. Believe me, yes, because for that a regular batch is needed. Yes, we develop each and every formula. We ensure that students by end of this chapter, yes, need not have to by heart even a single formula. Yes, they can develop the formulas themselves, but it requires time. Now from the examination perspective, quickly let's try to understand how we can recall, recollect and ensure that in the examination, if a question comes, we are in a position to tackle that. Is it clear, everyone? Now standard costing, it is a technique for cost control. So I'll be setting a standard. Based on that, I'll be comparing my actual. Based on it, I'll try to reduce my cost. Now look at this, students, different ways, yes, in which I can be using my standard costing. Now suppose I'm telling, yes, I thought that I should be getting a profit of 100 rupees, but actually I only got a profit of 80 rupees. What all could be the reason, students? Yes, my profit is nothing but my sales minus my cost. So either there could be a change in my sales or there could be a change in my cost. Change in my sales is called as sales variance. Change in my cost is called as cost variance. Again, change in cost. Either it could be a change in my material cost, labor cost, variable overhead cost, fixed overhead cost. So altogether 5 variances: sales variances, cost variances in that, material cost, labor cost, variable overhead cost variance, fixed overhead cost variance. Is it clear, everyone? Now coming to material cost variance. Material cost. What is my material cost, students? Yes, I have to purchase a material. How do I get my total cost? It is nothing but my quantity into price. Say for example, I went to purchase, yes, say for example, textile. Okay, I went and purchased fabric. 2 meter fabric at the rate of 100 rupee per meter. What is my total cost? 200 rupees. It is nothing but the quantity into my price. Yes or no, everyone? Yes, material cost is nothing but my quantity into price. Now, overall, if my material cost has changed, that means either my quantity should have changed or my price should have changed. Change in my price is called as material price variance. Change in my quantity is called as material usage variance. Overall change is called as material cost variance. Material cost variance is nothing but my standard cost of raw material minus my actual cost. Say for example, I thought that standard, I want 2 meter cloth at the rate of 100, 200 rupees will be my cost. But actually I've used 2.5 meter at the rate of 125. Say for example, I'm telling it is somewhere close to 250. Forget the numbers. Yes, overall how much extra I've incurred? 50 rupees. That is my material cost. Now two reasons. One is, yes, there is a change in my price. I thought I should have purchased at 100, but actually I've purchased at 125. Second, there is a change in my quantity. I should have used 2 meter, but actually I've used 2.5 meter. Yes, change in my price is called as price variance. Change in my quantity is called as usage variance. Now look at this, students. My overall variances I've bifurcated into 3 columns. One is my total variance. Yes, here the structure is simple. It is my standard cost minus my actual cost, overall change. Yes, then I have my price based change or my rate based change or my recovery rate based change. Here my multiplier is going to be actual. Yes, all my multiplier here will be actual. Then I have my quantity based change or hour based change. Here my multiplier will be standard. What is it? Just give me a minute. I will explain to you. Yes, make it as clean as water. Look at this price variance. What is it, students? It is the change in price. So I am going to call it as the difference in price. Convert it into value. So my material cost is price into quantity. So it has to be multiplied by quantity. Which quantity? Standard quantity or actual quantity, students? I've told my multiplier is always actual. So I have to multiply it by actual quantity. As simple as that, my formula is ready for you guys. Yes or no? Now look at this. 100 rupees I should have paid, but instead I've paid 125. That means 25 rupee per meter extra I've paid. Like this, actually for how much meter I've paid extra? I've paid extra for 2.5 meter. It is difference in price converted into value multiplied by quantity. Which quantity? Actual quantity. Coming to usage variance, it is the change in my quantity. It is the difference in quantity converted into value multiplied by price. Which price I should be multiplying with? I should be multiplying with my standard, that is my standard price. Is it clear? Yes, difference in quantity. Instead of 2 meters, I've used 2.5 meters, 0.5 meter extra at the rate of standard price, 100 rupee per meter. That means overall 50 rupees extra. Is it clear, everyone? This was my material cost variance. Similarly, let us try to understand every other variance. Then I am having my labor cost variance. What is my labor cost, students? Labor cost is the thing but my hours into rate per hour. Suppose I had an employee, he worked for 8 hours, I have paid him 100 rupee per hour. Altogether, how much I have paid? 800. Yes, if overall my labor cost has changed, that means either my hours should have changed or else my rate per hour should have changed. Change in my rate is called as labor rate variance. Change in the hours is called as labor efficiency variance. Overall change in cost is called as labor cost variance. Labor cost variance, overall change in the cost, it is my standard cost minus my actual cost. Now labor cost has changed, either rate may have changed or my hours may have changed. Change in my rate is called as labor rate variance. It is the difference in a rate converted into value. Rate has to be multiplied by hours. Which hours am I going to multiply, students? Multiplier will be actual, so I will multiply by my actual hours. Is it clear? Coming here, labor efficiency variance, that is the change in the hours. It is the difference in hours converted into value, multiply by rate. Which rate will I multiply, students? I will multiply by my standard rate. As simple as that. You've got the logic. Yes or no? Yes. Now quickly let's go ahead. Again, not dwelling deep, students. Just from your examination perspective, quickly I've explained. Yes. So it is nothing but my, yes. Again, when I'm telling difference in price, difference in quantity, always I'll be writing standard minus actual. Difference in price, it is my standard price minus my actual price into my actual quantity. This is how we'll be developing the complete form. Is it clear, everyone? Now, variable overhead cost variance. It is the change in cost. Yes, because of change in my variable overheads. Now, variable overheads. How do I get my variable overhead, students? It is my hours into recovery rate per hour. Say, for example, electricity. Yes, per hour my electricity cost is, say, for example, 20 rupees. This way I should be using for 10 hours. That means my total cost is going to be 200 rupees. It is the hours into recovery rate per hour. Yes, overall change in variable overhead cost. I have my variable overhead cost variance, which is nothing but my standard overhead cost minus my actual overhead cost. Yes, now overall two things could be there. Either my hours may have changed. If my variable overhead cost has changed, either my hours may have changed or else my recovery rate may have changed. Yes, change in my recovery rate is called as variable overhead budget or expenditure variance. Change in hours is called as variable overhead efficiency variance. Now, change in my recovery rate, variable overhead budget or expenditure variance. It is the difference in a recovery rate converted into value. Difference in recovery rate, it has to be multiplied by hours. Which hours, students? Here my multiplier is actual. I will multiply it by my actual hours. Case of material, I have told you the logic in a simple way. Same logic continues here also. Now coming here, efficiency variance, it is the difference in hours. So it is the difference in hours converted into value. Difference in hours, hours has to be multiplied by recovery rate per hour. Which recovery rate per hour I am multiplying, students? Here I will be multiplying with my standard recovery rate per hour. Again, when I am telling difference in hours, it is my standard hours minus my actual hours. Needless to say that. Is it clear, everyone? So quickly we have discussed material also, labor also, variable overhead also. Now let's quickly go to sales variance. Fixed overhead cost variance, we'll come to it later on. Sales variance. How do I get my sales, student? Suppose I am selling this pen. 10 pens I have sold. Every pen I have sold at 30 rupees. What is my total sale value? 300. How did I get it? It is quantity sold into selling price per unit. Yes or no? It's my quantity into selling price per unit. Now, overall change in my sale value is called as sales value variance. Now, if my sale value has changed, two reasons. Either there should be a change in my sales quantity or else there should be a change in my selling price. Change in my selling price is called as sales price variance. Change in my sale quantity is called as sales volume variance. Is it clear? Yes. Now, coming to variance calculation, students. I calculate all my variances in such a way that if my resultant answer is positive, I tell it as favorite. Now, in case of all my cost variance, I have written it as standard minus actual. Now, think and tell me, students. Yes, I thought. Yes, in order to produce this shirt, the material needed. Yes, standard cost of the material needed is 200 rupees. However, the actual cost is only 180. Is it good? Is it bad, students? It is good, yes or no? It is favorable for the organization. So how did I get that? 200 minus 180 is equal to 20 favorable. So every cost variance, how will I be writing my formula? I'll be writing it as standard cost minus my actual cost. If my standard cost is more, if my actual cost is less, that means it is favorable. However, when it comes to sales, sales is my revenue. It is reverse. Yes or no? Suppose I thought my sale is going to be 1000 rupees. However, my actual sale is only 800. Is it good? No, it is bad. However, if my actual sale, I thought my sale should be 1000. My actual sale is 1500. Is it good? Yes, it is good. So in case of sales variance, how am I going to structure my formula? I'll be writing it as actual minus standard. All my cost variance, I've written standard minus actual. In case of sales variance, I'm going to write it as actual minus standard. Now, sales value variance, it is my actual sale value minus my standard sale value. Standard sale value, you can also call it as your budgeted sale value. Now, sales price variance, it is because of your change in price. So, I'm going to tell it is my difference in selling price converted into value. Selling price has to be multiplied by quantity. Which quantity, students, in this particular column? Multiply with your actual quantity. That is your actual selling price minus your standard selling price into your actual quantity. Sales volume variance, it is because of the change in the quantity. It is a difference in quantity converted into value multiplied by your selling price. Which is selling price, students? You have to be multiplying it with your standard selling price. Yes, standard price I have written as SP. So it is your actual quantity minus your standard quantity multiplied by your standard price. As simple as that. Any doubts till now, students? Just with the pure simple logic, we have developed all the formulas. Now, again a caveat, it might be possible that things might be slightly fast. Yes, believe me, we are not discussing and developing everything. We are quickly revising. Okay, so if you can understand, well and good. Otherwise, I'm helpless. Okay, in this particular case, because the objective is to finish the complete revision within, yes, 40 to 45 minutes. Yes, if I go on to explain the concept, it's going to take 6 to 8 hours, students. Yes, now coming to activity-based costing. Now, where do I use activity-based costing? It is used, yes, to distribute my variable overheads. Wherein my overheads, it is variable, but it is variable based on other than units. In decision-making chapter, we've already seen. Say, for example, setup cost. It is variable, but it is variable based on number of setups. Yes, more the number of setups, more will be the setup cost. Say, for example, my setup cost is 1000 rupee per setup. That means if I do 20 setups, it is going to be 20,000 rupees. Now, how do I get my cost in case of activity-based costing? Yes, it is number of times the activity is performed into the rate of the activity. Say, for example, setup. Yes, number of times the setup is performed. 20 times I have performed the setup. Yes, into rate of the activity. One time to set up my machine, my cost is 1000 rupees. That means my total cost is 20,000 rupees. Yes or no? In a very simple way, I'll tell number of times the activity is performed, quantity of cost driver into rate of the activity. I'll call it as rate of cost driver. So in very simple terms, yes, I've got my formula. In case of activity-based costing, my overhead is nothing but my quantity into rate. Now keep in mind one thing, students. Yes, the structure of my activity-based costing is going to be similar to my variable overheads. Yes or no? Because variable overhead is also overhead, it is variable based on units. This is also overhead, it is also variable, but it is variable based on other than units. That's the only difference. Now names, yes, I'm going to call overall change, I'm going to call it as my flexible budget variance. Again, overall change could be because of change in the rate of cost driver, which is called as budget or expenditure variance. It could also be because of the change in the quantity of cost driver, which is called as efficiency variance. Just give me 2 minutes, everything will be clear. Yes, now flexible budget variance. Now in case of activity based costing, I've told you, yes, the structure of the formula, it is your quantity into rate. Now overall your flexible budget variance, it is your standard cost minus your actual cost. Okay, now two things. Yes, first you're having your budget or expenditure variance, then you're having your efficiency variance. Budget or expenditure variance, here we are seeing the impact of change in the rate of cost driver. Yes, we are seeing the change in the rate of cost driver. So I'll tell difference in rate, change in the rate of cost driver, difference in rate, convert it into value, rate has to be multiplied by quantity. Yes, here which quantity we are going to multiply with, students? We'll be multiplying with my actual quantity. I'm telling this difference in rate is there on my entire actual quantity, which is my standard rate minus my actual rate into my actual quantity. Is it clear, everyone? Now coming to my efficiency variance, we have a simple example here, don't worry. Yes, here it is the impact of change in the quantity of my cost driver. Yes, so I will tell it is the difference in quantity converted into value. Quantity has to be multiplied by rate. Which rate I should multiply, students? I will be multiplying with my standard rate. So it is my standard quantity minus my actual quantity into my standard rate. Is it clear, everyone? Now look at this very simple example. Yes, suppose example I am setting up my machine. Yes, standard, I thought for my actual output I should be setting up my machine 20 times. For every setup it should be costing 200 rupees. So I thought it should be costing me 4,000 rupees. However, actually we have set up the machine 19 times, and for every setup the cost was, say for example, 250 rupees. That means overall the cost is going to come as, yes, 250 into 19. How much is it, students? It is 4,750. Yes or no? So you thought cost should be 4,000, but actually it is 4,750. 750 extra you incurred. It is overall your flexible budget variance is 750 advance. Now two reasons are there, students. Yes, firstly, you thought that 20 setups we should be doing. However, actually we have done 19 setups only. Yes, I should have done 20 setups, but I have done 19 setups only. I have got the work done in 19 setups only. That means one setup I have saved because we were efficient. Yes or no? So it is the change in my cost driver, change in my quantity. One setup I have saved. That means if I have saved one setup, how much cost I would have saved, students? Yes, for every setup, ideal cost is 200 rupees. That means 200 rupees I have saved. 250. Is it clear? Now, next part, I am telling, okay, one setup I have saved. That is fine. However, for every setup, ideally the cost should have been 200 rupees. But actually we have incurred 250 rupees per setup. That means for every setup, we have incurred 50 rupees extra. Change in my rate, 50 rupees extra I have incurred. For how many setups I have incurred this? I have incurred this for my 19 setups. So 50 into 19 is going to be, yes, I think it is going to be some 950 adverse or something like that. Yes, so overall I will be getting 750 adverse. Is it clear, everyone? So using a simple logic, yes, we have explained all the formulas. Believe me, students, standard costing is one of the most simplest as well as scoring subject. Yes, scoring chapter. The only thing is you should understand what these formulas are trying to tell. Okay, yes, now the chapter is more or less over. Some additional points are there here and there. Yes, material usage variance. Sometimes if I am having two or more than two material, I can further analyze. Now, firstly, what is the structure of my material usage variance? It is my difference in quantity, convert it into value, multiplied by standard price. It is nothing but standard quantity minus actual quantity into standard price. So I'll write, yes, standard quantity, actual quantity. Now if I'm having two or more than two inputs, yes, it could be possible that either my quantity is changing or my mixing proportion is changing. Okay, so standard quantity I'm telling, it is my standard quantity in the standard mix. Actual quantity I'm telling, it is my actual quantity in the actual mix. Now two things are changing, quantity is changing, mix is changing. If I have to compare, yes, if I have to compare one thing, other thing should be constant, only then I can compare. If I have to compare my quantity, mix should be constant, yes or no, mix should be same. If I have to compare my mix, quantity should be same. So what I'm doing, I'm bringing in a new term called as a revised standard quantity. I'm telling, okay, yes, you've used extra quantity, actual quantity, fine. Yes, if I had used my actual quantity in the standard mix, what would be the impact? So I'm bringing in a new term, revised standard quantity, which is my total actual quantity in the standard mix. Now, when I'm comparing my standard quantity with the revised standard quantity, standard quantity is a standard quantity in standard mix. RSQ, it is my actual quantity in standard mix. Mix is same, however, quantity is different. I'm going to call it as sub-usage variance. Now, when I'm comparing my revised standard quantity with actual quantity, it is my actual quantity in standard mix. This is my actual quantity in actual mix. Quantity is same, however, my mix is different. So I'm going to call it as my mix variance. So how do I get it? It is my, yes, sub-usage variance. It is my SQ minus my RSQ. I get the difference in terms of quantity. I should be converting it into value. multiplied by standard price. Yes or no? In usage variance, I have multiplied it by standard price. So throughout my multiplier will be standard price only. I can tell my multiplier is going to be standard price. Yes, mix variance. It is my RSQ minus AQ. I've got the difference in terms of quantity. Converted into value multiplied by my standard price. This is how we will be calculating further analysis of usage variance. At the final level, it is not necessary, but still, if it is asked, I have shown you how we are going to do the calculation. Is it clear, students? Similarly, in case of labor as well, I am having my efficiency variance that can be analyzed further. Again, now I will not be explaining logic anymore. Labor efficiency variance. Yes, standard hours I am having, actual hours I am having. Standard hours is a standard hours in standard mix. Actual hours worked, it is the actual hours worked in the actual mix. I'll be bringing in a new factor. Two things are changing. Hours is changing, mix is changing. I'm bringing in a new factor called as revised standard hours, which is my actual hours worked, however, in the standard mix. When I'm comparing SH with RSH, yes, mix is same. Look at this, students. Mix is same, however, hours is different. I'm going to call it as sub-efficiency variance. Standard hours minus revised standard hours. I got the difference in terms of hours converted into value. Here my multiplier is standard rate. Here also my multiplier is going to be standard. When I'm multiplying revised standard hours with actual hours, is actual hours worked in standard mix, actual hours worked in actual mix. Here hours is same, however mix is different. I'm going to call it as my mix variance, which is my revised standard hours minus my actual hours worked converted into value multiplied by my standard. Is it clear, students? Now, if you know how to develop these boxes, telling, okay, I have my standard hours, I have my actual hours. Yes, it is my standard hours in standard mix, actual hours in actual mix. Yes, I have two things are changing. I'll be bringing in a new factor called as revised standard hours, which is my total actual hours in the standard mix. Once you know to develop the box, variances, formulas, you will create by yourself, students. Is it clear, everyone? Now, in case of sales variance also, I had my sales volume variance. It was the difference in sale quantity converted into value multiplied by standard price. It was my actual quantity minus my standard quantity into my standard price. Same, if I'm having multiple products which I'm selling, I can analyze it further. Telling I have my actual quantity, I have my standard quantity. Actual quantity is actual quantity in actual mix. This is my standard quantity in standard mix. Two things are changing. I'll be bringing in my revised standard quantity, which is my actual quantity in my standard mix. Now I'm comparing actual quantity with the revised standard quantity. Look at this, students. Quantity is same, however mix is different. I'm going to call it as my mix variance, which is my actual quantity minus my revised standard quantity. I got the difference in terms of quantity converted into value multiplied by my standard price. Now I'm comparing revised standard quantity with standard quantity. It is actual quantity in standard mix. It is standard quantity in standard mix. Here mix is same, quantity is different. I'm going to call it as my sales quantity variance. It is my revised standard quantity minus my standard quantity converted into value multiplied by my standard price. Is it clear, everyone? Now overall everything that we have discussed is just under two simple logics. Firstly, material logic we have told. Overall change. Again, here my multiplier is actual, here my multiplier is standard. Now this one further analysis we have told, if you are having two or more than two inputs, yes or no? Yes, standard quantity, actual quantity, standard quantity, standard mix, actual quantity, actual mix. Based on that revised standard quantity, we compare, we develop the formula. On that, everything till now we have discussed. Is it clear, everyone? Again, keep in mind, yes, if you are someone who is listening this for the very first time, could be possible that nothing will strike your mind. Believe me, yes, this is a chapter for which we dedicate 20 to 25 hours. So if you're telling me that within 1 hour this chapter should be over, believe me, it's humanly impossible, students. If you're having some idea, I can help you make it better. If you're having, your idea is not proper, your concept is not that clear, but still you're having a small idea, I can help you guys develop. If you're having completely zero idea, believe me, I cannot do anything in the given limited time. That's the limitation here at mind. Is it clear, everyone? Yes. Now, going ahead, students, going ahead to one of the most interesting discussions. Okay? Yes. Believe me, till now, only in one logic, one formula we have developed based on it, everything we have discussed. Now, sales volume variance. Yes, we have to understand it further. Now, sales variance, students, sales variance can be calculated in three different ways. One is based on my turnover, one more is based on my contribution, one more is based on my margin. Yes, based on turnover, by how much my turnover has changed, my sales turnover has changed. It is the quantity into my selling price per unit. Suppose I am telling I have sold 1 unit extra. That means every unit I was selling at, say for example, 200 rupees. That means I would have got overall 200 rupees extra. Now, otherwise I am telling I don't want by how much my turnover has increased. I just want to know by how much my contribution has increased. I will tell 1 unit extra I have sold quantity into for every unit what was my contribution. Say for example 120 rupees into 120 per unit. That means I have got 120 contribution extra. It is quantity sold into contribution per unit. Otherwise I am telling I want how much my profit has increased. My margin has increased. Again I will tell it is my quantity into margin per unit. Say for example 1 unit extra I have sold into for every unit margin was 80 rupees. That means 80 rupees extra. So yes, my sales variance I can be calculating using 3 ways. Using my turnover, using my contribution, using my margin. Now understand students, sales variance overall has 5 formulas. Sales value variance, sales price, sales volume, further analysis, yes, sales, quantity as well as sales mix variance. Ideally most people, yes, 5 variances on turnover, 5 variances on contribution, 5 variances on margin, 15 formulas. Yes, generally, yes, faculties make students by heart. But we have just understood one simple logic that we had developed during material costing. Using the same logic without any extra by hearting, we are going to understand in all different scenarios what is going to happen. Now firstly students, in case of two things can change. Yes, either my quantity can change, yes, or else these factors can change. Now very simple thing, I am telling sales, yes or no, sale is nothing but my quantity sold into selling price per unit. Yes, firstly, in case of change in selling price. Now I am telling I am selling 1 unit only. But originally I thought I would sell this product at 100 rupees. Look at this. Originally I thought I will sell it at 100 rupees. Yes, say for example my cost is 60 rupees. Profit was 40 rupees. However, actually I have sold it at 120 rupees. That means what happened? My sale price variance is 20 rupees favorable. I have sold the product at 20 rupees extra. That means what will happen? 60 rupees will be my cost because I am selling 1 unit only. That means how much will be my profit? My profit will also increase by 20 rupees, yes or no? My contribution will also increase by 20 rupees. Now look at this very important observation students. Change in my selling price is equal to my change in contribution is equal to my change in margin. By how much amount my selling price has increased, by that amount only, by the same amount my contribution will increase, by the same amount my margin will also increase. So my sales price variance, whether I calculate based on my selling price, whether I calculate based on my contribution, whether I calculate based on my margin, my ultimate value will be same. There is no need to separately calculate, telling okay, yes, if you are going based on turnover, this is the variance. If you are doing based on contribution, this is the variance. If you are doing based on margin, this is the variance. So what I will do for sales price variance, which is my difference in sales price, yes, into my actual quantity. This I will use the same formula, difference in selling price into actual quantity. Whether question is asking me calculate your variance using turnover, contribution, margin, because in all the three my answer is going to be same. Is it clear? Yes or no? If I increase my selling price by 20 rupees, that means my contribution will increase by 20 rupees. That means my margin will increase by 20 rupees. So basically all the three variances will be same. Is it clear everyone? However, in case of change in quantity, suppose I have sold one more unit. Yes or no? I was selling 1 unit at 100 rupees. Same previous example. 100 units, 60 rupees, 40 rupees. I was selling 1 unit at 100 rupees. 60 rupees was my cost. 40 rupees was my profit. Now I sold 2 units. That means my total revenue became 200 rupees. However, when I am selling 2 units, to produce that extra second unit, I should be incurring cost as well. Again 60 rupees, I will incur 120 rupees. That means by how much my profit has increased? 40 rupees only. By how much my sale has increased students? 100 rupees. But by how much my profit has increased? 40 only. Yes or no? So my sales volume variance, by how much my sale value has changed because of the change in my quantity. Yes, it is not equal to, yes, sales contribution volume variance. It is not equal to sales margin volume variance. Yes or no? If my sale has increased by 100 rupees because of extra quantity sold, it does not mean that my profit has increased by 100 rupees. It does not mean that my contribution is increased by 100 rupees. Is it clear everyone? So in this case, all my variances are going to be different. Now sales volume variance. What was the structure of the formula? I've told sales volume variance, change in the quantity. It is difference in quantity converted into value multiplied by standard price. Standard price, yes, I multiply by my standard selling price where I want the change in my total sale value. If I am telling I want only the change in my contribution, yes, I'll be telling it is my difference in quantity. Yes, converted into multiplied by standard contribution per unit. Yes or no? If I'm telling I want just the change in my profit, just the change in my margin, I'll be telling it is difference in quantity into my standard margin per unit. Is it clear, everyone? Now look at this, students. Suppose I am telling, look at this, 1 unit selling price is 100. Yes, contribution is, say for example, 40. Margin is, say for example, 20 rupees. Suppose I am telling 2 unit extra I have sold. That means total how much sale extra I have got? 200 rupees. Difference in quantity, 2 unit extra into 100 rupee, 200 extra I have got. How much extra margin I have got? 40 per unit into 2 unit, 80 rupees. Difference in quantity, 2 unit extra into 40 per unit, 80 rupees. How much margin extra I have got? 20 per unit into 2 unit, 40. Difference in quantity into standard margin per unit. Yes or no, students? So I can tell my sales volume variance. What was the formula, students? I have told it is my difference in quantity multiplied by my standard price per unit. But when do I want a standard price per unit? When I want my variance based on turnover. If I want it based on, yes, contribution, what should I do? I should multiply by my standard contribution per unit. If I want it based on margin, what should I do? Same difference in quantity, I should be multiplying by my standard margin per unit. Is it clear, everyone? Yes. Now, bringing back, yes, all the things together. Yes, I've told my sales variance can be calculated using 3 ways: turnover, contribution, margin. Now, I've told sales price variance, sales volume variance. Sales price variance, whether you calculate based on turnover, yes, contribution, margin, everything is the same only. However, your volume variance, it is different in 3 cases. Yes. Now, the general structure, it is volume variance, difference in quantity converted into value multiplied by standard price per unit or standard contribution per unit or your standard margin per unit. Now, when to use which one? Yes, we'll be doing the reconciliation of profit. So I don't want by how much my turnover has changed. I just want to see by how much my profit has changed. Now, there are 2 different approaches. One is your absorption costing, one is your marginal costing. In absorption costing, I'll be considering total cost. In marginal costing, I'll be considering only my variable cost. In marginal costing, all my decisions will be based on my, yes, contribution. So in case of marginal costing, my multiplier will be standard contribution per unit. Okay. However, in case of absorption costing, yes, I'll be taking my decision. Total cost I'll be distributing. So my multiplier is going to be standard margin per unit. Is it clear, everyone? Yes, this was with respect to our sales variance. Very, very, very important, students. In a very simple way we explained. Otherwise, just to develop those 15 formulas, just to write it down only, it is going to take more time. Is it clear, everyone? Should we continue, students? Yes. Now, we are also having fixed overhead cost variances. Now, believe me, students, in CA final level, fixed overhead cost variances are not important. It's not generally asked. If you see all the variances, all variances reconciliation questions are based on marginal costing. So this is not required, but still in a very quick way I'll explain. I'll just read the formulas again. Yes, in case of marginal costing, I'll be using only fixed overhead budget or expenditure variance. However, in case of absorption costing, all variances I should be considering. Now, what all variances are there, students? Yes, firstly, fixed overhead cost variance, overall change in fixed overhead cost. I'll be telling how much overhead cost I've absorbed, I've recovered, minus how much overhead cost I've actually incurred. Say for example, yes, 90,000 I've absorbed, however 1,10,000 I've paid, that means 20,000 adversities. These my absorbed overheads minus my actual overheads. For that, 2 further bifurcations are there, again not getting into detail. Yes, firstly I'm telling fixed overhead volume variance, second I'm telling fixed overhead budget or expenditure variance. Suppose I am telling I have absorbed 90,000. Yes, the budgeted overheads, I thought at the start of the year 1 lakh. Yes, actually I have incurred 1.1 lakh. Yes, first I will be telling, see, it is my fixed cost. Initially you thought it is going to be 1 lakh for the year. Why is it 1,10,000? Why has it increased by 10,000? It is my fixed overhead budget or expenditure variance. By how much my overhead has increased, my actual overhead has increased beyond my budgeted overheads. It is my budgeted overheads minus my actual overheads. Now, secondly, I am telling, okay, 1 lakh was your budgeted overheads. Yes, correct. That means 1 lakh you should have absorbed. Yes, why did you not absorb 1 lakh? Yes, we have absorbed only 90,000. That means again 10,000 it was. Yes or no? Volume variance, because we could not produce that many quantity that we thought we should be producing. Is my absorbed overheads minus my budgeted overheads. Now keep in mind one thing, students. Yes, if question is asking you to do reconciliation based on marginal costing approach, the only variance in marginal costing, I am not considering fixed overhead only. I am not absorbing fixed overhead only. All my decisions I am doing it based on contribution. The only cost I am considering is my variable cost. So ultimately, when I am doing my profit reconciliation, only thing I will be seeing is my fixed overhead budget variance. How much I thought my overhead will be, how much is my actual overhead. What is the difference? However, in case of absorption costing, all my variances will be considered. Is it clear, everyone? Yes. So with this, majorly all our formulas we've discussed, students. Believe me, in half an hour, all the formulas quickly we've understood. Now, if you are doing reconciliation, generally reconciliation of profit will be there. Some golden rules to be kept in mind. Firstly, go from your budgeted profit to actual profit. So from your budgeted profit, you go to actual profit. Okay. How you should be going? If you are having any favorable variances, add them. If you are having any adverse variances, reduce them. Next, one more point. Consider your variances at the last level. What is it at the last level? Say for example, I am telling material cost variance is 1000 favorable. Material price variance is 600 favorable. Material usage variance is 400 favorable. Now, while I am doing my reconciliation, I should be considering, yes, my variances at my last level. See, in my reconciliation, I will be considering material price variance, material usage variance. Material cost variance I will not be considering. So, no, why? Material cost variance, what is material cost variance? It is nothing but total of your price as well as usage variance. So, if you consider cost variance again, it is going to be duplication of work. So, I will not be considering the totaling of my variances. I will be considering my variances only at the grassroots level, only at the final level. Okay, fine. Yes. Then, what is the difference? If question is asking you to do reconciliation as per absorption as well as marginal, two differences are there, except that everything else is changed. Everything else is same. Yes, it's 4:30. Yes, damn sleepy. Yes, kindly adjust. Now, two differences. What all are the two differences, students? Firstly, in case of fixed overheads. In case of fixed overhead, absorption costing, all my variances I should be considering. However, marginal costing, only my fixed overhead budget or expenditure variance. Okay, next, sales variance. In that sales volume variance, sales price is going to be same. Sales volume variance, by how much, yes, my sale value, my contribution, my profit has changed because of change in my sale quantity. Yes, in case of absorption costing, I'll be calculating sales volume margin variance, by how much my profit margin has changed because of the change in my sale quantity. In case of marginal costing, I'll be calculating sales volume contribution variance, by how much my contribution has changed because of the change in my sales volume. Is it clear, everyone? Now, final 2 points are there. After that, it will be end of the chapter also. I can also go back to sleep. Okay? Yes. Now, two more things are there, students. Yes. One is my market size and market share variance. Yes. Now, sales volume variance we had discussed. Yes or no? What is my sales volume variance, students? It is my difference in quantity converted into value multiplied by standard price. Yes or no? Which is my actual quantity minus my budgeted quantity. Multiplier could be your standard price per unit, or it could also be your standard contribution per unit, or it could also be your standard margin per unit. Now, a very simple example I am telling. Based on that, you will only develop, students. Look at this. Budgeted quantity was 5 lakh. I thought in the next 1 year I will be selling 5 lakh shirts. Yes, how am I going to sell 5 lakh shirts? I thought that my market size for the next year is going to be 10 lakh. Okay, in that I will be having 50% share. Fine. Now, if my actual quantity has changed, that means either my market size should change or else my market share should change. Yes, actually my market size was 12 lakh. Okay. Yes, actually the quantity that I have sold was 8 lakh. Fine. Now, what is my sales volume variance, students? Just tell to me on the basis of quantity. I thought I will be selling 5 lakh units. Actually, I have sold 8 lakh units. That means overall, how much extra units I have sold? 3 lakh extra units I have sold. This is my sales volume variance. Now, I am trying to understand the reason. Now, look at this, students. Originally, I told 5 lakh I will be selling. On what basis I told? I told that 10 lakh will be my market size. In that, 50% share I will be having. That means 5 lakh I will be selling. However, what happened? My market size increased and became 12 lakh. That means if my market size was 12 lakh, how many units ideally I should have sold? Ideally, how many units I should have sold? On 12 lakh, 50 percentage means 6 lakh I should have sold ideally. if I had maintained my market share. Yes or no? That means this 1 lakh increase in sale, I thought I'll be selling 5 lakh. However, actually I should be in a position to sell 6 lakh. Because of what I am in a position to sell 1 lakh extra? It is because of the increase in my market size. Yes or no, students? Initially I thought 10 lakh will be my market size, but my market size became 12 lakh. If my market size is increased by 2 lakh, that means automatically my sale will also increase. Yes or no? I am having 50% share. So my sale should also increase by 1 lakh units. This is my market size variance. It is not in my control. It is not something I have done by myself. Market size increased, so I have sold more units. Yes or no? Now look at this. Okay, even if my market size was 12 lakh, assume. Yes, ideally, if I was maintaining 50% share, I should have sold 6 lakh units. But actually, I have sold 8 lakh. So I have sold more than what I should have sold in my actual market size. What could be the reason, students? Even at 12 lakh market size, I should have sold 6 lakh, but actually I have sold 8 lakh. What could be the reason? Yes, I have gained my market share. Yes, my market share variance. I have got my market share. Is it clear? So this is how I bifurcate my sales into my market size variance, market share variance. I have got the quantity. Convert it into value. Multiplier is different. Simple. I have got my quantity. Difference in quantity. Multiplier could be your standard price per unit. Could be your standard contribution per unit. Could be your standard margin per unit. So I'll be telling 1 lakh units into my standard contribution per unit, or else your standard price per unit, or else your standard margin per unit. Market share variance, it is 2 lakh units into, converted into value, multiplied by your standard price per unit, or else your standard contribution per unit, or else your standard margin per unit. Is it clear, students? Do not unnecessarily complicate. Now look at this. Even without any formula, we have developed the answer. It's just about understanding the pulse, telling what this concept is trying to tell. That's all, students. Now finally, we are having planning and operational variance. What is it trying to tell, students? Now, even here, market size and market share variance. My market size variance is called as planning variance. It is uncontrollable. Market share variance is called as operational variance, which is controllable. Okay. Now, planning and operational variance. Look at this. Say for example, originally I thought, yes, raw material I'll be purchasing at 2 rupees. Fine. However, actually I have purchased my raw material at 4.5 rupees. That means how much extra cost I've incurred? 2.5 extra I've incurred. That means my material cost variance is 2.5 rupees. Yes or no? This was my traditional variance analysis. Traditionally, this is how we used to analyze. But now we are telling I should try to bifurcate my variances into planning and operational, controllable and uncontrollable. What is it? Now look at this. When did I set my budget? I set my budget at the start of the year. At the start of the year, raw material was available for 2 rupees. So I thought, okay, 2 rupees I should be buying. However, during the year, my standard has changed. Is it possible? Yes, quite possible. Inflation is there, uncontrollable factors is there. Yes, standard has changed. So I am telling my revised standard. Yes, ideally, if I had purchased in this year, I could have purchased at 4 rupee only, because during the year, yes, the price throughout had increased. Yes or no? So what I am telling, original standard is there, actual is there. In between, I am going to bring in a new factor called as my revised standard. Original standard is also called as your ex ante standard. Revised standard is also called as your ex post standard. Now, when I am comparing my ex ante standard with my ex post standard, I thought it should be 2 rupees. However, ideally, if I have to purchase, it should be 4 rupees. This 2 rupees increase in cost, is it controllable, students? Is it controllable? At the start of the year, I thought it should be available at 2 rupees. However, during the year, inflation came, external factors changed, economic factors changed. Yes, ideally, raw material is available only at 4 rupees. Is it within my control? No, it is not within my control. It is uncontrollable. Yes or no? It is also called as a planning variance. However, okay, 2 rupees to 4 rupees it has increased. At 4 rupees, at least I should have purchased, right? But actually, at what price I have purchased? 4.5. Means this increase of 0.5 rupees, was it controllable? Yes, it was controllable. If I had purchased the goods properly, I should have got the goods at 4 rupees. However, actually I have paid 4.5 rupees. This is my operational variance, which is controllable. Now, how do we calculate the variance, students? Planning and operational variance could be asked anywhere. Question can ask you for material cost variance, labor variance, variable overhead, fixed overhead, activity based question. Wherever it wants, it can ask you to bifurcate your variance as your planning and operational variance. Very simple thing, students. In case of planning variance, what am I comparing? I am comparing my original standard with my revised standard. That is my ex ante standard with my ex post standard. Yes. Operational variance, what am I comparing? I am comparing my revised standard with my actual. That is my ex post standard with my actual. Now, how do I calculate my variances? All variance names will be same, calculation will be same. The only difference, look at this, students. Planning variance, I am comparing ex ante standard with my ex post standard. How should I be calculating my variance? Yes, calculate your variance, solve your variance, assuming your ex ante as a standard, ex post as your actual. Now I have to bring it down in the form of a formula. Say for example, this is my cost. Okay, 2 rupees is my standard cost, original standard cost. 4 rupees is my revised standard cost. 4.5 is my actual cost. I have to be seeing by how much my cost has increased, which was uncontrollable. I'll be telling by 2 rupees my cost has increased. It is adverse for me, which is uncontrollable. How do I get it? 2 rupees adverse. It is 2 rupee minus 4 rupees. Original standard minus my revised standard. In standard costing, how I used to do it? Standard cost minus actual cost. Yes, in place of standard, I am writing, yes, original standard, ex ante. Yes, in place of this, I am writing my ex post. So wherever you want to calculate your variance, very simple, students. First, write down your formula. Say for example, you want to calculate your material price variance, difference in price into actual quantity. So standard price minus your actual price into your actual quantity. Now, everywhere you are having standard, use your ex ante data. Everywhere you are having your actual, use your ex post data. You will be getting your planning variance. Is it clear? Solve your variance assuming your ex ante as standard performance, ex post as your actual performance. Now I should be getting my operational variance as well. So no, in operational variance, what am I comparing? I'll be comparing ex post standard with my actual performance. Now, how will I be solving? Same thing. However, now, yes, you are comparing 4 with 4.5. So, which is your standard now? This is my standard now, which is my actual now. This is my actual now. So, solve your variance assuming your ex post standard as your standard as well as your actual performance. Now, look at this, students. One simple example we have given you. Quickly, you will understand with this the chapter standard costing will be over, my dear students. Now, ex ante, ex post, actual. Originally, I thought 50, yes, raw material will be available at 50 rupees, 10,000 kg raw material is needed, so 5 lakh rupees will be my cost. However, actually I have paid 90 rupees per kg, actually I have utilized 12,000 kg, actually I have paid 10 lakh 80,000. However, ideally during the year what happened is my raw material price has increased, which was beyond my control. So ideally if I had purchased, I would have got my raw material at 80 rupees, 10,000 kg, that means 8 lakh would have been my cost. Now, if I am doing my traditional analysis, what will I be telling? Yes, originally I thought 5 lakh is my cost. Actually, 10 lakh 80,000 is my cost. That means my overall variance is 5 lakh 80,000 adverse. However, planning and operation variance is telling bifurcate it into controllable as well as uncontrollable. Okay, 5 lakh originally you thought, but during the year was it feasible? What was feasible? Yes, feasible was 8 lakh. At best, I could have purchased at 8 lakh. That means this difference from 5 lakh to 8 lakh is uncontrollable. It is my planning variance 3 lakh adverse. However, this difference from 8 to 10.8 lakh, 2 lakh 80,000, it is my operational variance. It was controllable. Is it clear, everyone? With this, we have literally squeezed the chapter standard costing. Yes, in 45 minutes. Yes, in the time possible. Yes, I have not made justice. I have not given you the logic of each and every point. But believe me, giving you the logic is going to take time. Yes, in our regular class, yes, we ensure that students understand the basics of standard costing, telling what it is, why it is, and they solve the question without any fear. Okay, however, this is a super fast revision wherein to that level we cannot go. So in the given time possible, yes, we have tried to revise the chapter and ensure that you have the knack to derive the formula as well as solve the questions from the examination perspective. Is it clear? With this, we end today's session. Yes, thank you so much, students. Keep studying, keep smiling, keep rocking, and see you for the next video. Have a great day.